Assalamu alaikum wa rahmatullah. For those people who are dropping comments about sound, yes, we didn't start yet. We will be starting in a couple of minutes, inshallah.
Wa alaikum salam, brother Majid.
Dr. Najdat, assalamu alaikum.
Wa alaikum salam. Nasılsın?
Good to have you.
وعليكم السلام. صباح الخير. صباح الخير جميعا. Good
صباح
morning
الخير.
everybody.
صباح النور.
صباح الخيرات أستاذ أمل. مرحبا. So we will be starting in a few minutes, inshallah. Now we have up to 56 participants. Hopefully the number will increase over time. Brother Omar will be joining in a couple of minutes. Please, if anybody in the team can answer the questions, somebody is dropping questions. Maybe this relates to the sound and connection. Professor Alam Khan, Ahmad Zai. Please, if you can drop an answer. Actually, for those who are dropping questions about their participation at this early stage of the session, we would like to just let them know that once we start and once the session is underway, they can take part in the session and they can join us, inshallah, online. Assalamu alaikum, Brother Omar.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Assalamu alaikum.
Minutes
Dear
to
Omar
start,
Ansari.
brother. Wa alaikum assalam, Dr. Najdat, just saw you.
Alhamdulillah.
It's always great to see you, sir.
Alhamdulillah.
Brother Majd, we are waiting for a few minutes. I think we have more registrations.
Yes, your registration is increasing by
Nearly 300 registrations, I think.
300 plus, yeah. As of today,
Yeah, so
300
let's
plus.
wait for maybe 2-3 more minutes.
Okay, for sure.
Buyurun.
Hocam günaydın.
Günaydın. Nasıl?
Şeker var mıydı hocam?
Yok, şeker almıyorum.
Çok şükür hocam. Sizler nasılsınız?
Sağ ol, teşekkürler.
Afiyet olsun hocam.
Just to remind those who have joined, we will be starting in a couple of minutes, maybe 5 minutes, as we are still waiting for a larger number of participants to join. In terms of registrations, we have up to 300 registrations. So that's why we are just waiting for a while before we start. And in the meantime, our team is answering the questions in the Q&A box. But please, for those who are joining now and dropping questions, please, if you can wait until the session starts, so we can have your questions one by one during the session, and that would be more appropriate for us to be, to go hand in hand with you in answering these questions or taking your comments on the provisions of this standard.
I think perhaps, Brother Majd, we can start.
We have up to now 75 participants.
Inshallah, they shall join.
Okay, Brother Omar.
I think we should start. I think we should start. The time
Okay.
is very valuable for all the participants.
Yes,
so
sure.
we should start.
Okay, ladies and gentlemen, the distinguished participants and guests, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. It gives us a great pleasure to welcome you to today's public hearing session on a newly issued exposure draft of AAOIFI Financial Accounting Standard, literally control of assets and business. As most of you are already aware, the public hearings as one of the 14 mandatory steps in standards development at AAOIFI are an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts like you on the newly issued exposure drafts. As exposure drafts may have far-reaching effects, the input received at such industry-level events would be the all-important for us to ensure that the final standards do live up to market expectations and faithfully reflect the distinct nature of Islamic finance and its products, services, and transactions. This standard prescribes the criteria of obtaining control of assets by assuming the risk and being entitled to rewards incidental to ownership of assets, including those related to underlying assets of instruments such as sukuk and participatory arrangements such as mudaraba, musharaka, and wakala. Additionally, the standard addresses circumstances when control is lost and sets out the principles for assessing the need to consolidate financial statements in case an institution controls a business. As a central standard for control, this standard brings all financial reporting requirements at one place in a bid to ensure consistency, ease of reference, and avoidance of redundancies. And now, without any further delay, let me invite to the virtual floor Mr. Omar Mustafa Ansari, AAOIFI Secretary General, who will present the exposure draft and walk you through its main content while interactively answering your questions and addressing your comments. All relevant comments and suggestions will be collected and presented to the respective working group to consider and make the changes it deems appropriate to the exposure draft. Mr. Omar Mustafa Ansari is addressing you. Brother Omar, over to you.
Thank you, Brother Majd. أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, distinguished guests, Assalamu alaikum wa rahmatullahi wa barakatuh. It is indeed a pleasure to be here with you again, and it is my utmost pleasure to welcome some very senior participants here, particularly Dr. Najdat Sensoy. There were a few other very senior people who actually were in the list of the participants. I'm not sure whether they have joined in or not as yet. Thanks, Sister Amal, for joining in as well, Sister Amal Al-Masri, and other distinguished participants. This standard is, I would say, it's a small and short standard, but this is like, this how I would put it, like, in words, that it actually covers some of the fundamental essential accounting issues of Islamic finance. On one hand, it tries to align Islamic finance with the conventional financial accounting standards, but on the other hand, it actually distinguishes how Islamic finance is different and how Islamic finance accounting has to be reflected slightly different in some of the ways according to its true essence. Now, saying this thing that that how Islamic finance is distinguished, for that purpose we need to also understand that even within the conventional accounting standards, IFRS and other generally accepted accounting principles, there is so much focus on the concept of control, the definition of asset, the recognition and derecognition criteria for assets and liabilities, as these are the fundamentals based on which the financial statements are prepared, profits and losses are determined, rights and obligations are rightly reflected in the financial statements. The definition of control is significantly aligned with IFRS definition by AAOIFI now. But there are still so many issues coming in different areas that AAOIFI Accounting Board considered it necessary to come up with a single unified standard on control and providing the relevant explanations related to control in form of its applicability at one place. The issue related to control and its definition are covered in AAOIFI's multiple standards. It is covered, I think, from FAS 28 onwards, maybe in 6 or 7 standards, maybe 8 standards. There, even the older standards, FAS 23 and 24, also have the control definition with regard to the business. And it was also an argument that the definition for control that has been put by AAOIFI should be aligned together with the definition of control on business, which is there in the earlier standards. And the conceptual question was as to whether and to what extent this control definition can be different. So if you control an asset and if you control a business, does the fundamental definition change, or the fundamental definition remains the same while the application of that definition and interpretation of that definition and the criteria for meeting that definition is different? So from that perspective, we considered that there should be one single fundamental definition of control, which should be aligned with the IFRS, and it should be identified in with different situations as to how this definition will be applied and to what extent the definition interpretation become different, or I won't say interpretation, rather the application guidance become different with regard to different type of the products. From Sharia perspective, I recall long time back when I was initially working on Islamic finance accounting standards, not at AAOIFI, but in another board. I remember one of the scholars, he said, the main guidance on accounting that is available in Islam is with regard to zaman, the risk and responsibility, risk and reward part. So he said the fundamental of Islamic finance accounting, when we consider purely from Sharia perspective and considering from where this guidance originally comes, is primarily zaman, or the responsibility and risk and responsibility part. As I look into this point that he raised, and as I see what work AAOIFI has been doing in last so many years, I fully acknowledge that those were the words of wisdom from our respected scholar. Because the most important issue with regard to accounting is what to recognize on your balance sheet and what not to recognize on your balance sheet. When to recognize it and when to de-recognize it. And how that recognition and de-recognition results in profits and losses, income and expenditure, etc. And this is the fundamental and the crux of accounting. Obviously, there are so many aspects of accounting. I don't want to say that this is the only thing, but this is one of the most fundamental points that should be clear in our mind when we want to discuss and we want to go for, Islamic finance accounting concepts. And when we identify the differences which are there from the conventional standards. So without further, this sort of background discussion, I would like to take you through the standard. The presentation that I will make is just a reflection of the standard in PowerPoint form. So normally we do not share it. The standard is available on the website. I hope that some of the team members, I think thanks to Dr. Rizwan Malik, he has provided a link to all the participants to the exposure draft of the standard in the chat window. I think it is shared another time by Sister Noof also. So you all have access to the exposure draft. We believe that most of you might have read the standard already. Let me discuss this thing because more recently in another public hearing, just a few 3-4 days back, we were facing a question from some participants who said that when we actually hold a public hearing, we actually read the important paragraphs, we go in quite detail. So at times public hearings are quite long, maybe taking 2 to 3 hours. I hope this one will not take too much because it's a shorter standard, unless we get delve into too much of debate, which is quite possible considering the significant aspects of this standard. But in a nutshell, we did a survey comprising of 2 questions. The first question was that how many of you, honestly, and you have to answer honestly, have read the standard exposure draft of the standard before joining the public hearing? And the second question is, those of you who read the standard already, to what extent you feel it is important to discuss the concepts and read the relevant parts of the standards as we feel important for that purpose, or is it enough to take the comments only? So our approach is always that we consider it like, not only a comment taking session, but we consider it to be an awareness session about it as well, about the exposure draft, surely, because at times some of the things are changed in the final version. But we want to explain a lot of things, to discuss, some of the nitty-gritties with regard to some important issues, etc. However, I just want to do this survey. We did it for a governance standard recently in the public hearing for a governance standard, and the results were more like roughly 50% of. I don't want to give all the answers. Maybe better if I give you answer of the last polls later, it will be good. So if Dr. Rizwan and Brother Majd, if you can kindly create a short poll. First question is that how many of the participants have read the standard exposure draft of the standard before joining in? And number 2, whether they feel that the approach with regard to explaining the standard in reasonable detail and keeping it more as a combination of awareness session and comment taking session versus only comment taking session, which means that we do not read or explain the standard unless there is a question and unless there is a comment. So let's take this poll. It might be a bit interesting to know how the participants today see it. With that, I would like to move to the standard as a combination of this standard is as a combination of control related requirements which are contained in multiple places. So there is one question that when we go through it, I would like to pose this question to all of you in the beginning, but we will try to take the answer in the end. And that is that, do you feel that bringing all the requirements related to control at one place is good idea? And if you feel it's a good idea, do we still need to keep control definition and related requirements in different standards which are already contained in 7 or 8 standards? Or would you prefer that we completely delete the control related definition and requirements in other standards and keep them only at this place? So this is another question that I would like to pose to you, but I would like to take answer of this question towards the end. Brother Majd, if you just to request you that once we reach the end, please remind me to take answer of this question if I forget.
Yes, these 2 polls.
Thank you, brother. So now I'll share the screen. I hope I'm allowed to share the screen. Yes, I hope it's working with all of you. Okay, so this is financial accounting standard on control. In bracket, it says of assets and business. Some of the requirements related, some of the contents of the preface and introduction I have already explained to you. So maybe we might not need to go in detail about it. Brother Majd, on IN 1, our style for uniformity, before and there should be no comma in 4th line, 5th line. And in IN 3, after AB, there should be a space. I'm sorry, some of the participants might not feel interested in some of the minor issues like this that I identify, minor formatting and language style errors. But actually, it gives me an opportunity to actually review the standard again. So before it is finalized, we can make some corrections. We all are human, and you cannot imagine by end of like 2022 when we were finalizing these standards. In 2022. AAOIFI accounting and governance boards together issued 11 exposure drafts of standards, finalized 5 standards, and issued additionally, on the accounting side, we issued additionally one very important document, very comprehensive, that is the illustrative financial statements. So considering the work that we did in that only 1 year, maybe you can excuse us for these minor mistakes, and we'll try to make sure that before the standard is finalized, we are able to handle these issues. Any comment that you may have, please, you are requested to provide it in the Q&A tab, and you can also raise your hands. Brother Majd, I think you would be happy to see that now we have a century of participants. Although registration was up to 300, in the beginning, the participant number was quite less, but it is good that we have at least this number. We have Professor Alam Khan Ahmed Zai. He has raised his hand, so I think we can allow him to speak. If you can see attendees list, Professor Alam Khan Ahmed Zai. So if he can kindly be allowed to speak, allowed to open up his mic and speak, please.
Yes.
Is he allowed now?
Yes.
Yes.
Okay. Respected Professor Alam Khan Ahmed Zai, if you want to speak, you are allowed to speak now, sir. Your hand is raised. So
I think
if
it
it
has
was
raised
raised
since
by...
the start, so it's okay.
Hello, can you hear me?
Yes, we can hear you, sir. Please go ahead.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam, sir.
Yeah, it's my pleasure. Thank you for giving me the time because I'm in the USA and it is night. That's now today. Now it is 11:30 p.m. in California, USA. Thank you for giving the time. I read this standard. It's look professionally prepared, but there are some missing points in the definition as well as the control of assets. And also, I can see there is no place for digital assets in the whole paragraphs of this paper. And as well as I can see there's some deficiencies in the definition of digital assets, because now world is now world is changing into digital economy, and here in the USA, the digital assets concept is now becoming stronger and stronger, as well as in the world. I cannot see anything that can explain the future. So this standard is going to be developed for the 57 Islamic countries, as well as other institutions in non-Muslim countries who follows the AAOIFI standards. So therefore, I have a few suggestions, and I want to email them because I don't want to take a lot of time, because I can see hundreds of people are now as a participants, and I want to share to put that comments in reply of that email. Is that okay for all of you?
Thank you very much. First, for joining in at at a time which is inconvenient to you. To be honest, we are highly honored and thankful to you. And I would say that we try to hold our meetings in 2-3 different time zones. But every time I feel that for people from North America, but even it is always a challenge for our members of boards and working groups from North America, because most of the time they have to do a jihad actually by joining in at Tahajjud time. So for you, maybe still it's not Tahajjud time, but still thank you very much for joining in. Number two, for the benefit of all participants, I would say that at times you may mention your comments here, but maybe you may not have enough time, or at times we may not be able to allow you enough time. And at times it is possible that you want to go through the standard again before you send the comments. So in all these situations, the comments are open to be received. You can always provide your comments at accounting@aoifi.com. So you are more than welcome to send your comments in writing. Even if you are unable to attend a public hearing, but you can just manage time to read the standard, you can always kindly provide your comments in writing to accounting@aoifi.com. I would request Brother Rizwan and Sister Noof, either of them can put this email address in the chat box. Thank you very much, sir, for joining in. With regard to the digital assets, we take your comment very positively. Thank you very much. Maybe it will be one of the agenda points for us. But as of now, what happens that our framework for financial reporting actually includes the definition of an asset. And that definition of an asset is about a resource that you control. And that resource that you control actually, the definition that we have is aligned with IFRS and other generally accepted accounting principles. So it is a resource that you control, and it actually impacts your future cash flows. Now, this is an additional question that I would like to put, that at times when some of the definitions are provided in our framework or in the financial accounting standard number 1, at times we do not repeat them in all of the relevant standards. As I believe digital assets, if they are genuinely digital assets, not speculative things, they will meet the criteria of an asset, the definition of an asset. But I was just checking very quickly. I think we have not reproduced the definition of asset here. So this might be a question to the participants if they feel that, because normally we are now trying not to repeat the definitions unless they are necessary. But if at times it is very important to keep a standard in a definition to make it able to be read, in its own self, means that standard itself should be complete. So you cannot provide definition of everything, but if something is very important, the definition should be there. So maybe, Sister Farida, we can make a note of it, that the definition of asset might be needed to be added to this one, because we are talking about control of asset and business. So maybe the definition of asset and business from that perspective might be needed here. Again, we'll take this comment, and we'll love to have your more comments, sir, and we'll be looking forward towards it. There is another hand raised, I think, by Brother Muhammad Mohyuddin Khalid. I think he can also be allowed to speak, please. Brother Muhammad Mohyuddin Khalid, you want to speak, or your hand was raised? Okay, before that, I can see Dr. Najdat has also raised his hand. Dr. Najdat, sir, please, you can speak.
Okay, thank you, Brother Ömer Ansari. Assalamu alaikum to all participants. I have noted two things, and one of them was about the definition of asset, and Professor Alem also referred that. I see tangible, intangible, monetary, non-monetary. Also, we can add financial, non-financial. I couldn't see financial, non-financial. If we do that, also Professor Alem's request or offer, suggestion can be there. We can define assets as monetary, non-monetary, financial, non-financial, and tangible, intangible. My second note was about paragraph 10, section C. There we say that assets divided owner's equity, quasi-equity, off-balance sheet. Brother Ömer, as you know, assets are resources, owner's equity, quasi-equity are in the sources side. When we say assets divided to owner's equity, it is a little confusing. Maybe we can make
it is 10C you are talking about. I can't find 10C. It is
sorry.
It is like, you know, 11 has C, but that goes for control of assets. So you are talking about para number again?
10C.
There is no 10C, Sister
Huh?
Farida. Can you correct me?
Okay,
no
maybe
10C,
11C.
brother.
Okay, 11. Let's go to 11.
11. Yeah, 11 has C, but that is for
No,
business,
no.
not for control.
No.
Maybe you are talking about 8C. 8C is losing control of an asset.
Brother, I think it's looking at maybe
7C. 7.
I saw as I am looking for on my telephone. It is. Let me check again. Like
I think it's
10C.
transfer of asset standard. It sounds like the transfer of asset standard.
Okay, that one might be on transfer of asset standard. When I think when we did that public hearing last time,
What assets? I am looking to today's transfer of assets between investment.
Yes, brother. It's transfer of asset standard.
Last time when we conducted the public hearing, we covered both standards, I think, together. Am I right, Sister Farida?
No, brother. We only did transfer of asset.
Okay, sorry.
Okay.
I clicked to the
wrong one, maybe.
link.
Yeah, maybe you opened the wrong file, sir.
Okay.
That's why it happened. Dr. Nijdat, sir, about having the definition of asset, we agree with you. I believe we will take it to working group. However, the monetary, non-monetary, financial, non-financial, tangible, intangible. The question is, does the criteria of control change by type of asset? If there is an asset, let me put this question to all the participants. If there is an asset, any type, irrespective of the type, when we define the control of asset, does it make a difference if that asset is of a different type? I say that something is an asset of whatever type. I say I gain control of it, I acquire control of it, or I lose control of it, or I derecognize the asset. Would it be actually happening that I need to change the criteria there?
No, I am not referring to the criteria, but to definition.
Okay, we'll consider adding the definition, sir. I think we have monetary and non-monetary definition in other standards.
My suggestion is to add also financial, non-financial. It is missing, isn't it?
Okay, you are talking about the transfer of asset standard, that where there we have not covered financial and non-financial.
Yes.
Dr. Nijdat, sir, right now this is not the topic, but I could explain to you that actually financial asset, which is considered as per IFRS, might not meet the definition of monetary asset from Sharia perspective. The transfer of asset standard has the monetary and non-monetary from the perspective of tangibility criteria of assets transfer. So the tangibility criteria does not consider financial or non-financial, because financial, non-financial as per IFRS may include some of the assets that at the back end have underlying assets which are non-financial. So for example, shares of a company as per IFRS are financial asset, but they may contain at the back end non-financial assets, which mean that for the purpose of tangibility criteria, they will be considered non-monetary. So we don't want to mix up in the transfer of asset standard. We do not want to mix up financial with monetary. We want to stick to monetary and non-monetary because that is more relevant from tangibility criteria perspective. And rather we said that it is to be considered only in the specific context of that standard. So since we cannot have more debate on that standard because that is not from this standard, so we can have a separate discussion on it if you like, or if we can have it, we can make sure to invite you on the next public hearing that happens on the transfer of asset standard. However, your comment is taken and it will be taken to the working group of the transfer of asset standard.
Thank you.
Now I would like to
Brother,
please.
I have class at 10, therefore I will leave.
Sure, sir. Thank you very much for being here
And
with us. You are always encouraging us. Allah bless you and providing great comments. Thank you very much. It is always highly appreciated and acknowledged. Thank you very much, sir. So I would like to now move to the body text of the standard. Now, I'll not be allowing everybody to speak unless we are sure that we have enough time. So maybe I'll request all of you to put your comments in the Q&A tab, not the chat window, but rather the Q&A tab. So we will be taking comments from there. If time allows, we will be taking more comments on the through audio if the time allows. Now, coming to the objective of the standard, the objective of the standard is to establish the principles of assessing as to whether and when an institution controls an asset or a business, both in the case of underlying assets of a participatory structure as well as for the purpose of consolidation of financial statements of subsidiaries. Sister Farida? Sister Farida?
Yes.
Can you make a note of it? Sister Farida, Brother Maj, can you make a note of it? I think there is one more aspect. Because I remember there was some editing done in the board and the working group, but it's not only in the case of participatory structure, rather even for the normal asset recognition, this criteria has to be applied, even if it is not an underlying asset of a participatory structure. So actually we should say that it should cover all the three situations: normal recognition and derecognition of asset in the financial statements, then the underlying assets of a participatory structure, and then the consolidation. Brother Majd, have you kindly noted that? I think there was some editing done after the initial discussions in the working group. Our working group and board did some editing, and I think this point was missed out.
It is taken.
Okay, thank you very much, brother. Now coming to scope, this standard shall apply to all institutions preparing. I think we have a comment in Q&A tab. Anonymous attendee, Assalamu alaikum, brothers and sisters. That the number of participants are more, and because of time difference for me being in USA, it seems that I will not be able to enough time to comment. Following are some of my points to be included. I think it was Dr. Alam Khan. In definition, the control of assets assigned by order of court should be included. We will consider that. Obtaining control by order of the court, lose the control by decree of a court. The control of digital asset is not described. Participatory assets, Muzariya, Musaqat, and Mugharsa are not mentioned, and digital assets are not covered. Thank you very much, sir, for very good comments. Some of them we may consider in the body text. Some of them may be explained in the basis of conclusion. I'll come to this comment about the order of the court when we go to the criteria. I'll partially respond to that. Thank you very much, Dr. Alam Khan. Very, very valuable comments. For sure, we'll consider them, but as body text or as explanation, I'll explain some part of it going forward, and then we'll take it to the working group, and the working group and board will decide as to how we incorporate it. Thank you very much again. Okay. Scope. This standard shall apply to all institutions preparing financial statements, in line with the requirements of AAOIFI financial accounting standards. The standard shall also be applicable to the entities being party to Sharia compliant transactions and structures, even if not included in the definition of an institution, insofar as allowed by the respective regulatory and reporting framework. Why we have put it, it has its own significance. For example, there is a government entity that issues sukuk based on maybe ijara muntahiya bit tamliq, or based on wakala or any other structure. Now the question is that transaction should also be assessed from the perspective of having control. So the point is, although it's not an institution that is following generally Islamic finance accounting standards by AAOIFI, but it is still doing a transaction which is an Islamic finance transaction. We had this debate long at AAOIFI board and in different forums that what is the scope of AAOIFI standard setting? Does it apply only to the institutions? And our answer is that our scope is developing standards for Islamic financial institutions, Islamic finance transactions, and we also cover social finance and other ancillary matters. So from that perspective, the Islamic finance transactions, even if not done by Islamic financial institutions, are part of our standard setting. So a company, corporate entity that issues sukuk based on wakala and says in its contract that the risk and reward incidental to ownership of these assets has been transferred to the sukuk holders, and then the company acts in the capacity of an agent to just manage those assets. In that situation, I'm just putting an example. In that situation, even that company should be applying this standard, but for sure, obviously, it has to be notified for that purpose by the respective regulators. And I can assure you that whatever we have provided in this standard, even if it is applied under IFRS framework and under other generally accepted accounting principle, in its true essence, then it's still the treatment might not be different from the treatments that we have mentioned here. A group of people may be the part of a scope who are not registered as legal entity or who are involved in the asset ownership and controls. This is a good comment. Actually, when we say an institution, we have its own connotation to the institution, because our institutions include virtual reporting entities also. So from that perspective, it is covered rather much, but I think it would be good to clarify in the body text or in the basis of conclusion that the term institution here includes a virtual reporting entity in line with the AAOIFI's financial reporting framework. It is understood, but it is better to explain it. And this way, a confusion may not be there. So a group of people in this form, as you are talking about, sir, becomes a virtual reporting entity. And for us, a virtual reporting entity, like, for example, sukuk, we have a very clear concept of virtual sukuk entity. In the financial reporting of financial accounting framework, we have clearly said that financial reporting need to be done at times by virtual reporting entities. So from that perspective, we believe that the framework and things cover it, but either in the body text or in the basis of conclusion, we'll provide the explanation so that this confusion that you raised should not be there. Thank you very much again for very valuable comments, sir. We have comment from Lucky Baranda. Is this standard applicable to all companies? I mean, have you put healthcare industry into considering if creating this standard? One of the important factors that most Islamic value hospitals fail to comply is preparing this. Thank you very much for your important comment. If the healthcare company is constituted in form of a waqf, then it is covered by us, because we have financial accounting standard number 37 on waqf, and we say that waqf institutions have to follow requirements of FAS 37 along with other requirements of our relevant AAOIFI standard. So from that perspective, a waqf institution will follow it. But if the institution is not a waqf institution, but rather it's in form of a company or another form, which is not within the scope of AAOIFI, then in that situation, it may be applied to such companies only in case of sukuk and other Islamic finance Sharia compliant structures. Again, it's a good question. I do not want to go into this detail. Maybe if necessary, the working group may agree to put it in basis of conclusion. I hope my answer would be good for you, but acceptable to you. But if explanation is needed, the working group will see as to how to explain it in the basis of conclusion. I hope Sister Farida and Brother Majd are taking notes of these important points.
Yes.
Definition. So we have just limited definitions here in this standard. Others are understood, but I think that asset definition should also come here. I agree with this comment from the framework of FAS 1. Control is as defined in para 5. We'll go to detail in para 5. Participatory structure is the type of contractual arrangement under which the parties to the contract share the profits, losses, and or residual interest in the net assets of the underlying assets or business. So musharaka, mudarba, and all those things are actually part of participatory structure. So with the comment, one comment from Dr. Alam Khan is actually addressed here that muzara, musaka, etc., if they become participatory structures, they are already covered. So we do not go by every product. Rather, we are talking about participatory structure. So even we are not talking about musharaka, mudarba, wakala separately. We are actually giving references or like examples as to how the definition is to be applied in different situations. But the main main topic of the standard or the main concept of the standard goes with the participatory structures. Quasi-equity is an element of the financial. This is a definition which is already there in some of our standards. In a nutshell, let me explain it. I don't want to read it word by word. Quasi-equity is the are the instruments, participatory instruments, who are having primary characteristics of equity, but are having a put option or a redemption option, which means that from IFRS perspective, they become a liability. So we say that they are having primary characteristics of equity because they share profits and losses and residual interest in the net assets, but they have certain characteristics of liability like put option or maturity or redemption. And obviously they have some specific feature like, for example, they don't share in every in the whole of the business, rather they share in the underlying assets or business only, and they have their own, like, rights. Rights are different, like shareholders' rights are more with regard to management of business as compared to the investment account holders' rights. Now, coming to the most important definition, as I mentioned, this definition has already been covered in the AAOIFI's framework as well as in some of the standards, including FAS 28. FAS 29 is not yet final, but that also has it. FAS 31, FAS 32, I think FAS 30, I think 6 or 7 standards at least include the definition of control. And that was the purpose, that we want to keep it aligned and to bring it at one place. Maybe in future we'll not be adding to any of the standards, but as I put a question to the participants, I would like to know how they look at it. Now, before I go to this definition, I just recalled that we have requested for a poll. Now, can we have all the participants answer the poll? What is the position of the poll, Brother Majd? How much percentage is actually done? How many of them have responded already out of 100 participants? I can't hear you, Brother Majd. I think you are muted.
Yes, the poll is run. Now we have, can you see the poll? It is.
No, I can't see the results. I think the results can be seen by the admin and the creator only.
Brother Rizwan, you create the poll. Can you share? I can see it here from my end.
Brother Rizwan, can you? First thing is that have all of the participants responded to the poll, please? If anybody has not responded to the poll, please respond quickly.
Yeah, brother, we have 70 so far who have answered. Yes, and the percentage is like yes to the first question. Have you read 51 and no 49.
Okay, and about the second
approach,
do you think
approach is 86%, 86% preferring the first approach, the awareness and comments, and 14% comments taking session.
Thank you very much, Brother Majd. Thank you very much. And I think this is important to know how people actually think about our approach. And so thank you very much about it. Only one request, that all of those who have not read the exposure draft before coming, at least if you have a look at it before coming to the public hearing, maybe you can add more value, you can provide more valuable comments. It is quite possible. So we just request you, but I think this confirms our understanding that the approach that we are normally following is more preferred by the majority. You're suggesting, Brother Dr. Alam Khan is suggesting, I think you may mention that Muzara, Gharsa, Musaka are different than Musharka. Actually, for us, from accounting perspective, we are developing standards on principal basis. So if they fall in a participatory structure, then the accounting will remain same as participatory structure. You will just see whether you control the asset or you don't control the asset. So approach is not going to be that we identify them whether they are different or not. Brother Majd, it reminds me of a completely separate point that when we are revising phase 3 and phase 4, we might need to consider if we want to cover the agricultural partnership products, like, at least because the core principles might be the same, but there might be some minor treatment differently. So I think it might be even good if we cover at least the agriculture partnership products and in that standard, which is like, the combined revision of phase 3 and phase 4. Just make a note of it.
Okay, thank you.
Brother Alam Khan is very optimistic that for the future for Islamic finance, Muzara, Musgharsa, and Musaka will be practices because these are the specific and particular principles in Islam. I personally, what you have said is my hope. I just feel that unfortunately our banks and our Islamic financial institutions are not focusing on these directions, but considering the current food security issues across the globe and so many challenges that are there, I believe and I hope that it should happen. Thank you very much for your kind comments, sir. But still, that may not be a subject of this standard. Rather, as I mentioned to Brother Majd, that we have our standard on Musharka and Mudarba, which we are revising in form of combined standard on participatory ventures. And I think in the same standard, we'll touch upon the agriculture participatory ventures as well, inshallah. We have comment from Brother Anwar Musbah. Okay, Brother Anwar's comment. Thank you very much for Brother Anwar Musbah Subra. First, thank you very much for joining in. It is like, always great pleasure to have senior people like you here coming here. I'll take your comment first. Well, let me read 5 and explain, then I'll take your comment, sir, because it's related to para 5. An institution controls an asset or business when it has substantially all risks and rewards and incidental to ownership of such assets or business, duly meeting both of the following conditions. A, it is directly exposed to and has rights to variable returns, negative and positive respectively, from its involvement in such assets or business. And B, it has the ability to affect those returns through its power over the assets or business. So there are 2 things. One is variable returns. Second is governing power. The power is you can sell it, you can use it, you can consume it, you can rent it out, you can even destroy it, like, sort of means that you have the rights over power of that asset. But that power is, if you are having that power in fiduciary capacity on behalf of others, that is not for your own variable returns. So variable returns. And the second part is variable returns. People think at times that, okay, variable return is about variable rate of profit. No. Even under IFRS, the variable return talks about negative and positive, which means that the gains and losses also. So if you are just having a gain-based variable return, that, okay, you are having a variable return within gain, but in case of loss, you are not responsible, that is not variable return for that perspective. The definition that we have taken is very much aligned with IFRS, but has been improved from Sharia perspective. So we make it actually the substantially all risks and rewards incidental to ownership of such asset or business. Actually, this is also accounting terminology, but it is inserted in this definition to ensure Sharia compliance, because Sharia wants about ownership, and that these 2 criteria about risk and rewards, the risk and reward are established through these 2 criteria. Number 1, the variable returns from your investment in such asset or business. And secondly, to ability to govern that, like, and the power to actually to sell, use, consume, lease, etc., of that asset for your own benefit, for your own variable return. This is important. Power for your own return. So you must have power and you must have variable returns, and both are conditions that are part of this exhaustive list, in a manner that all these things have to be there. So you must have substantially all risk and reward incidental to ownership, and that is established through this and this. All of these things together ensure that you own the asset or business, or you control it and you should put it on your balance sheet. Now, coming to, I have some explanations also. I'll take comments. There are some comments, but let me quickly go through 2 or 3 of these paragraphs to explain for explanation. Okay, before that, I'll try to explain you the structure of the standard. The structure of the standard is that this definition is common definition, which applies to assets or business both. But then we have section on control of asset and section on control of business in a way that we explain how this definition, the same single definition, is interpreted and applied in the context of assets and businesses, and if there are additional conditions and parameters that are to be considered for the assets or businesses to be considered as controlled and put on balance sheet, for that purpose we have put some additional parameters and explanations also. So let me first take comment on paragraph 5, particularly because Dr. Anwar had a comment here and I can see some other comments in the Q&A tab. So first let's take comment from Brother Anwar. Control of asset clause 5 refers to the case where the entity has all risk and involved substantially all. Brother Anwar, I think then substantially all does not mean all. Substantially all is the term that we have used. We have not used the term all. While clause 11 refers to the ability to execute power, it holds 50% of voting rights. Clause 3 also confirms the concept of having the power. Question: does having the power mean control? Sir, I think I tried to explain that having the power does not mean control unless that power is used for your own variable returns. This could be clarified maybe in the definition section, and consequently should the term all risk and reward be replaced by 50% or more? No, sir. 50% or more apply. It is the interpretation that is applied for the business purposes, because you control. If you own 50%, if you own 50% ownership right, you control whole of the asset, whole of the business. In case of assets, substantially all risk and reward, you need to have for all of it. So actually, these things are to be interpreted in the right manner. So, Dr. Anwar, with due respect, I would tend to disagree with your kind comment because we have talked about one, not all, but substantially all. Secondly, 50% establishes the governing power to control. It does not mean that you own, it brings the asset on your balance sheet, but the proportion of that asset or business which is owned by others actually has to be recorded as a quasi-equity or as minority interest. So these are the conditions. The main thing is here, this standard is about establishing whether the asset and business has to be on your balance sheet or not. That is the criteria. That is the test. For that test, I would humbly tend to disagree with your kind comment, sir. Consider kindly in view of my response that it is about substantially all, and 50% actually is not the ownership issue. 50% is the power issue. It is the variable returns. You may have 40%. You may have 40% variable returns, means that you own 40% of the shares. But through de facto control, you can still control it because you have the power to govern it, and you have the variable returns coming out of it. So in that situation, you will still recognize the whole of the business on your balance sheet, even if you have 40% for your variable returns and 60% for minority interest or for quasi-equity. So I think I'm able to explain to your issue. But when we reach that place about the de facto control, etc., I'll try to explain it further, sir. We have comments again from anonymous attendee. I think again it is Brother Alam Khan, sir. May I request you to kindly change the username. I think Brother Rizwan, you are showing the poll results on screen. If you can share it. Can it be shared on the screen for the benefit of all participants? So vast majority says that approach in that we explain the standard is better, and 53% participants said that they are actually joining in the meeting, joining in the public hearing after reading the standard. Thank you very much. I think it is great. Now I think the poll can be closed. I think we have 74 answers. The panelists and speakers can't be voting, so maybe 80-90% people already responded. Okay, you are not considering Islamic perspective of production because of Islam divides the production into following categories: manufactured-based production, natural products. In manufacturing products, humans have full control, while in natural production, humans have no or limited and restricted control. While determining the negligence of manager of the production, which is considered by Musharaka but not considered in Muzara, Musaka, and Mugharsa. And I hope you understand what I'm trying to tell you. Otherwise, please give me more time or communication means to explain it further. Sir, we highly appreciate your comment. We will request you to kindly provide your comment on this point in writing because that is not less related to this standard. The issue of control, as of now, we have not talked about the types of assets and their relevant control. So that might be a subject of our another standard, as I referred to Brother Maj, to kindly make a note with regard to the participatory ventures. So with regard to the participatory ventures, we would love to have your comment. So may I request you to kindly provide this comment about the control of agriculture related and natural product related participatory structures, if you can provide that to us. From our perspective in accounting, we do not distinguish everything by product. Rather, we go by principle. One principle may be applied on 5 different products. So from that perspective, I would request that we may not be able to go into further detail with regard to this subject of agriculture-based partnerships. In this standard, we would love to have your comments in writing, which we will be taking to the relevant working group is working on the participatory ventures. Again, thank you very much for your kind comments. And we appreciate if we can get these in writing as well, sir. Okay. Brother Anwar has made a comment. He recommends that we need to clearly define control and power. Sir, I think we have tried to define control and power in the relevant section, but we will try to put more explanation within the body text as well as from the basis of conclusion, inshallah. Thank you very much for a very important comment. Inshallah, we'll try to incorporate that. Sir, we cannot change your name. Actually, you need to go to your to the name as it's appearing, and you need to go right click, and probably you can change it yourself. I think the administrators can't change it. Anyway, I can't change it because I'm logged in as a panelist, not as the administrator. Thank you very much again, sir. Can Sister Farida, Sister Noof, can anybody provide him just a step-by-step guidance as to how the anonymous attendee name can be changed, please? Okay. How to rename yourself? Okay. In the Zoom window. Okay, thank you very much. Let me move now. The second part that I said that now the structure, the definition was common. But now we define the control of asset, how that definition applies to control of assets. In line with the definition of control, see paragraph 5, an asset shall be considered to be in control of an institution when the institution has the present ability to direct the use of asset and obtain economic benefits that may flow from the use of asset. Control is also exhibited when the institution can prevent other parties from using the asset and obtaining economic benefits from the use of the asset. An institution usually obtains control over an asset once it acquires substantially all the risks and rewards incidental to ownership of the asset. So this is the explanation of the same definition in the context of control of assets. Thank you very much for the second poll with regard to retaining and deleting control aspect in relevant standards. So the question is whether we keep control related section in all the 6, 7, 8 standards that we have already included and even in the future ones, or we delete these requirements from all the standards and keep them only at one place here. So you all are requested to answer this question. Now coming to the control of assets, obtaining control of an asset. So that was the interpretation, how control definition is interpreted and applied in the context of control of assets. Now, coming to obtaining control. An institution may obtain control of an asset through having risk and reward incidental to ownership of such asset, generally when A, the asset is acquired as consequence of consummation of a contract, the contract becomes legally binding on both parties, and the consideration, if any, is paid or becomes payable. Here we were discussed, we got a comment with regard to a court order and a court decree. Now we need to consider whether it is to be added here as another condition, or we need to provide an explanation that a court order or something like this creates a sort of a contract situation. So maybe we need to have some legal input on that aspect. But thank you very much for an excellent comment. We'll try to consider that part, inshallah. Losing control of an asset. An institution may lose control of an asset in various situations, including when the asset A is sold to a counterparty or is given to another party as a gift or through another form of tabarruk, for example, waiver of rights or receivable or a hiba in sharing of profits, or is lost, destroyed, or distributed, or ceases to provide any economic benefits, for example, due to technological obsolescence or legal or other restrictions on their use. On its use, Sister Farida, please make a note of it. On its use, it is ceases, singular. We are talking about a single asset, okay? The restrictions on its use. We have a comment from Noor Nakato. How about you delete the requirements elsewhere but maintain a reference to this standard? Surely, if we delete from other standard places, it will come here. So maybe when we are saying that we delete from other standards, it means that it will create a reference to this standard only. So the definition will be saying as defined in paragraph this of this standard. It would be more like this. So thank you very much for this comment. When we delete from other places, for sure, a reference either in the body text or in the footnote will be there. Thank you again. Now, let's continue the discussion, and then we will take comments on this section altogether at one go. An institution shall recognize acquisition or disposal of an asset according to the respective phase when it obtains or loses control of the asset respectively. An institution originating sukuk shall determine the extent of control by the institution over the assets underlying the sukuk instrument depending on the structure, entailing contract, product, governing the relationship of the sukuk holders, the SPV, and the institution. Now, this is completing the section on control of asset. So if there is another comment on control of asset, please feel free to provide your comments in the Q&A tab before I move to the next section with regard to the control of business. Okay, there is no further comment right now. So I just can see. We have a comment from Nigahe Nazar. What are the types of control? There can be different types and forms of control. I'm just thinking, the objective of this standard was not to determine the types of control. Rather, it was to provide the principle-based guidance as to what would constitute control. So from our perspective, we have just put two types of control here. One is control of assets, and the second, control of business. And we structured according to that. Now, there can be additional elements to that, like, for example, de facto control in case of business. So there can be these sort of situations, but the purpose was not defining control. So for us, we only had two types of control in this standard: control of asset and control of business. And how that control is established, we are keeping the options according to principles, not as according to specific products and further details. Thank you very much for your kind comment. Brother Anwar again has a comment. Clause 8b, transfer of possession cannot be based on donation, but must actually and necessarily be in all cases by means of sale contract. Okay, let us come here, brother. 8b or 8c? 8b. Yes. Dr. Anwar, according to Sharia, the contracts can be of two types. One is exchange contract or a commutative contract, and the second is a tabarruk contract. A tabarruk contract completes when actually something is like, donated by one party or given as tabarruk in form of different form like hiba or something by one party or waiver of rights, and the second party accepts it. So for example, I offer to you that, okay, this is a cup, this is a cup that is in my hand and I like this cup very much, but I'm willing to give it to you. When I say that I give it to you, it is hiba. Because tabarruk has different forms like donation, hiba, etc. But tabarruk is the main term. So if I give it to you as hiba, if you accept it, I lose control. Even if there was no consideration to that. So I lose control. So for example, there is an Islamic financial institution which has cash in hand. Now, according to the profit and loss distribution mechanism, there was a profit related to a customer like, 8,000 BD. But the bank decided to pay hiba also of 2,000 BD. Now, the question is, will you de-recognize that 2,000 BD if the counter customer is accepting that hiba? For me, yes. And this applies to cash and any kind of asset. This thing applies to any asset. So let me give you another example, a good example, even a better example. There are ijara muntahiyya bit tamlik models which work with a gift option. So once the lease term is completed, the bank gifts the car to the customer without any consideration. And these are the practical models that we have. So at that point of time, the bank will de-recognize the asset. It will say that I have lost control. I have given it form of hiba, but it is happening. Same may apply that, okay, I may have an asset. Like, yesterday I was talking to a friend that I have an old fridge. Okay, this is not good of me that I want to give old fridge in in donation, not a new fridge. It should have been ideally, I should give a new fridge. But my suggestion was, let's buy a new fridge and give old fridge in donation. If I was doing my balance sheet, don't you think I need to de-recognize that fridge from my balance sheet if I give it a donation and the counterparty accepts it? Now, counterparty acceptance is important. We agree. And that can be implied or expressed. Means you can have a written contract, or if I just give the fridge to a person and he takes it to home. That is implied, not expressed. But for me, the contract completes in form of gift also. And it applies in Islamic finance also. Brother Anwar, I'm not considering Sharia compliance of donation, but the fact that legally and operationally it's not practiced, we need to provide Sharia compliant concept with practical legal applications. In lease to own of asset, transfer of lease asset must be based on the sale contract and not donation. Dr. Anwar, we have products which are based on not donation, but hiba. Hiba is a form of tabarruk anyway. The condition by the counterparty, sir, is that the counterparty expressed it on implied basis because they take the car. So I'm sorry, I beg to differ, but again, let me clarify one thing. You already know it. You are so so prominently you have been so prominently attending our public hearing, so you know it all. But for the benefit of all participants, I would say any single comment that is received, even if I answer to it or try to clarify it, does not mean that we are killing the comment. No, all these comments are combined together. They are taken to the working group. Working group may have a fresh look at these. So if I provide a comment, I'm trying to explain something in light of what discussion was there in the working group and in the board, or at times as a professional having some knowledge about AAOIFI's framework, etc. I try to explain in light of framework and others. But all your comments will be taken to the working group. But I personally humbly tend to disagree, sir. Brother Anwar is saying HEBA is not legally recognized, sir, in some of the countries. I can tell you the HEBA as a part of the profit distribution is happening every time. Okay, Nikah Nazar has again a comment, sir. Can we book the donated asset received by a company, and what is the best rate for the record purposes if the company book of account? If you receive a donation or a HEBA, then the right way is that these are recognized at the fair value of the asset given. Actually, this is not very clear in every place, but IFRS, IS on government grants actually provides some of the guidance on that part. So there can be two approaches. One is that you recognize it at fair value and recognize a grant on the other side, and then you depreciate or recognize, or the second approach is that you recognize it at nil value but make a disclosure. Both approaches are acceptable, but as AAOIFI, we prefer the approach of application of fair value unless it is not determinable. We have comment from Barakat Abdullah. What about control of asset and musharka mutanaqisa, diminishing musharka? An excellent comment, actually. I'll just go into a different debate now. Let me try to explain. In Ijara Muntahiyya bit Tamlik, through gradual transfer, we have established that the asset is controlled partially by the lessee or the customer, and the remaining of the asset, he has the right of use asset. So for example, I have a housing finance from an Islamic bank based on musharaka mutanaqisa, based on mutual transfer, a gradual transfer. Now your question can be applied in two ways. First is, we say one of the party needs to have the asset in the book, or both of them to have proportionately in the book. We said that for the lessor, you record it like an investment in sort of a musharka, the mutanaqisa sort of venture. So you show it as an investment in that. And the customer books 70% or 30%, whatever he has as his own part of ownership as physical asset, and remaining 30% or whatever percentages as right of use asset. And we created a term that is called combined asset. Since it is not the subject of this standard, I would suggest to go and read FAS 32. And if you have any further guidance needed, you can write to us. We can provide further guidance on that, explanation on that. But in a nutshell, the approach is that the lessee will recognize a combined asset comprising of physical asset plus right of use asset, and the lessor, the bank, will be recognizing investment in musharaka mutanaqisa. Further details are available in FAS 32, and they are not subject of today's discussion, but we consider that asset you control the asset to the extent of ownership, but you have a combined asset in your books because you also have a right of use asset. So you make them both combined together to show them at one place. The core principle of control still remain the same. Okay, so now I need to move to the control of business. In the context of control of a business, now one of the purpose of putting control of business here is to align what is written in AAOIFI's new framework and the control definition with what is written in FAS 23-24, etc. FAS 23-24 will also be subject to a review. We have started the process, although it's going a bit slow, but the purpose is that we will be either partially withdrawing or completely withdrawing or improving the consolidation and associate accounting standards. In the context of the control of a business for the purpose of consolidation of financial statements, the definition of control, see paragraph 5, an institution in the capacity of an investor controls a business when it is exposed or has rights to variable returns from its involvement with the business and has the ability to control those returns through its power over the business. Here we have not used the term, Dr. Anwar, we have not used the term all here or substantially all here. We have said that substantially all term is more relevant to assets and less relevant here. But to the extent of your part, obviously it's substantially all, and you control all of them. If you control whole of the business. It is not that you don't control 40% of the business or 60% of the business. If you control whole of it. Only thing is that the remaining part that is not in your whose returns are not relating to you, you put them as minority interest or non-controlling interest or quasi-equity. Thus an institution controls a business if and only if the institution has all of the following. Has all of the following, Sister Farida. All of the following. Off is missing. Power over the business, exposure or rights to variable returns from its involvement with the business, and the ability to use its power over the business to affect the amount of the institution's returns. So 3 things. 1, power. I can make decisions. 2, exposure or right to variable returns from its involvement in the business. So if I own 50%, 51%, the variable returns, whatever I get out of that 50%, I am able to, I'm having that 50% right. The ability to use its power over the business to affect the amount of institutions' returns. This is the 3rd very important element, that we need to be able to use the power for returns. So having power and having returns without having the power to be able to control the returns is not complete. Again, this part is aligned with IFRS, and in the context of business, this definition is these conditions are an interpretation and application guidance for the control definition in the context of business, and it is actually considered to be sort of considered to be extension of the definition for the purpose of business determination of business to be controlled or not. Now, coming to the next section, there is a rebuttable presumption. Let me complete. I can see 2 comments are coming to Q&A tab, but I'll prefer to take all the comments now together once I explain it all. There is a rebuttable presumption that an institution enjoys the ability to exercise power over and govern a business when it, A, directly or indirectly through its subsidiaries, hold more than 50% of the voting rights. So this is the power. This is the power. Variable returns can be less than 50% also. But the power is established like this. So directly or indirectly through its subsidiaries hold more than 50% of the voting rights when either the relevant activities are directed by a vote of holders of the majority of the voting rights, or a majority of the members of the governing body that directs the relevant activities are appointed by a vote of the holder of the majority of the voting rights, or has the right to direct the activities of the business. So even without controlling as a holding more than 50%, you still may have the right to direct the activities of the business, and you may have control on that. I can say that, for example, I'll come to that thing. For example, you are a bank and you have mutual fund. In the mutual fund, your investment is 25%. You have variable returns less than 50%, but maybe you still have the power to these rights. Again, it is the example that I've given. I'll come back to that. There are more technical issues involved in that, so we'll come to that. An institution may have the ability to exercise power over a business despite not having the majority voting rights. Where the institution has less than majority voting rights, control may exist through, for example, the following factors. Sister Farida, just make a note of it. I think earlier there was a comment, and I think one of the earlier comments also Dr. Anwar's comment may also talk about that. Here we should not say control, we should say power may control like this. I'm just considering, like, for the reconsideration of the working group, don't make a decision. For reconsideration of the working group, we need to consider whether we say control or power here. Okay, in para 13. So A, the agreement with the business, other shareholders of business itself. So I own 30%, but the 70% owners have an agreement with me allowing me to run the business. Rights arising from other contractual arrangements. The institution's voting rights, de facto power. Now, again, a business can be other than company also. So there is a possibility that I created a venture myself, and that venture, it creates a quasi-equity situation. So even for those situations, I may be holding only 20%, 80% might be held by the investment account holders or sukuk holders, but through these contractual arrangements, I may still have the power. And that power may convert into control also. But I think we may need to explain this part, Sister Farida, slightly, what we mean by control and power here, okay? The institution's voting rights, de facto powers, we go to para 17, potential voting rights, or a combination thereof. So you can have a combination of more than one of these items. All these things are generally aligned with IFRS. Voting rights in a business include those that are accorded through shares or other equity instruments, as well as those that are obtained through agreement with the business, other shareholders, or the business itself. An institution shall consider only substantive voting rights in assessment of whether the institution has power over a business. In order to be substantive, rights need to be exercisable when relevant decisions are required to be made, and the holder of such rights must have the practical ability to exercise those rights. For the purpose of the standard, determination of voting rights shall include current substantive voting rights and currently exercisable voting rights. When making an assessment whether an institution controls a business, it shall consider the voting and other rights emanating from the investment in business duly funded by institution itself. Explanation. This includes owner's equity and other funds that are the liability of the institution and the quasi-equity. So for example, I control a business. I hope 50% of the ownership is established, 51% is established by including the portion owned by the equity, my equity, and my quasi-equity. Quasi-equity will be counted for that purpose. An institution itself, so if I took a loan through a like, you know, maybe we like it or we don't like it, but we may have a loan through like financing liability. Loan is not the condition, liability is the condition. So if I obtain a interest-free loan from the directors, or if I obtain a tawarruk-based liability. So all these things which are my liability as an institution can be considered to be part of my control on that on my asset directly, and quasi-equity can also be counted for that purpose. Any component of a business funded by the off-balance sheet assets under management, including restricted investment accounts, wakala, etc., shall be classified as non-controlling interest and accordingly identified as such in the financial statements. So it is not establishing my direct control. But then we come to paragraph 17. This is de facto power is there in IFRS also, but we have considered some additional aspects for de facto power in Islamic finance perspective as well. In certain situations, it may be established that although not fulfilling the conditions specified in paragraph 13 regarding power, an institution may still have de facto power, resulting in de facto control if variable return condition is also met over a business that gives it practical ability to direct the financial and operating policies of such business unilaterally. This may include situations when the institution holds significantly dominant voting rights, for example, because of widely dispersed shareholding patterns. So, for example, you own 45%, not 50% or 40%, but there is no single owner who owns even more than 5% or more than 3%. All other shareholders are like, widely spread. So it is quite possible that they are not going to form an alliance against you and having the control. So effectively in that situation, even 40% may establish a de facto control or significant voting rights under management. So I control for 35% through equity and quasi-equity on balance sheet. But I have off-balance sheet investments in that also, which are on behalf, managing on behalf of wakala or restricted investment account holder, but they hold additional 20%. So adding that 20% to my 35% becomes 55%. So it means other market players, other shareholders will not be having more than 45% at all. So I can still control because these are in my under my management. So technically, I can still control this one. So de facto control might be established this way as well. So again, this de facto control concept is coming from IFRS, but we have interpreted and applied specific conditions related to Islamic finance, for example, these off-balance sheet assets under management, etc. Agency concept. Let me explain this before taking comments. Okay, I think here we can take comments and then move ahead. So what happens to ownership? I think, again, this is Dr. Alam Khan. What happens to ownership transferred from an IFI to its customers against the down payment made in Murabaha transaction? Dr. Alam Khan, sir, from the perspective, again, we are going to a different discussion. From the perspective of accounting, I would like to humbly submit that payment doesn't matter. Ownership transfer matters. So down payment doesn't matter when the ownership transfer through transfer of incidental on risks and rewards incidental to ownership, including possession transfer, will be the criteria. So for me, down payment doesn't matter at all. I will recognize a sale, acquisition of inventory when I purchase the inventory and get the control of inventory, which includes possession. And I will de-recognize the inventory and record the Murabaha sale when I sell the asset and pass on the possession of the asset constructively or physically. So it can be through constructive possession, it can be done through physical possession, but possession would be one of the conditions to make sure that substantially all risks and rewards incidental to ownership are transferred. So for me, down payment doesn't matter. Your next comment on control of business comes from board of directors, which is sometimes are not the owners. You did not mention that what will happen in that case when the members of board of directors are not owners. You may include this also. No, sir, we don't need to include it. As I mentioned to you that actually the accounting standards when we develop are developed based on the basis of principles that can be applied in multiple situations at the same time. So when we said here, when we said it gives a practical ability to direct the financial and operating policies of such business unilaterally. This is about the board. This may include situations when the institution holds significantly dominantly voting rights. So that is covered here. Secondly, I'll take you back to the main three conditions. Agreement with the business, other shareholders or business itself, rights arising from other contractual arrangements, institutions, voting right, defective powers, potential voting rights. So if you consider that having people in board can be done either by shareholders, directly having other agreement with other shareholders, directly having the majority voting right, that is the first condition, even before this. So you can have it by majority voting right, you can have it by contractual arrangement, you can have it by agreement with other shareholders, and you can have it with your de facto power. Considering all these things, it will be applied. So the principle does not count the number of directors. The principle counts your direct power to control, that is coming directly from the majority shareholding, and de facto power to control, which is coming from these perspectives. So if you have shareholding, you have agreement with other shareholders, etc., obviously you will have representation in the board members. But we don't count neither IFRS nor AAOIFI. We don't count the number of board of directors members. But yes, that can be one of the parameters to determine that whether you have a de facto control, if it is sort of like, it is establishing that through this thing, you have the right to unilaterally control the operational and financial policies as I referred to. So then I'll move to agency concept. An institution may manage, and one last thing, actually, it took me to this concept, very important. The board of directors are agents to run the business. So technically, they do anything in the fiduciary capacity on behalf of their shareholders, whom they are representing. So technically, board of directors, having the board of directors without having other conditions. It is quite possible that you have all the board of directors or a majority in board of directors, but you don't have meeting other conditions. It is quite possible that you do not have power, because it is quite possible that the board of directors, people that you are having, are exercising the power in agency capacity, not in primary capacity. So I can tell you there can be conditions that there is a local partner which owns 30% and there is a foreign partner which owns 70%. The foreign partner in the company may allow the local partner to keep their directors, because it is more convenient to have directors locally. So they may have less directors. The foreign partner may have more voting rights, but less number of directors. Is still the voting right and the ownership and all those conditions are in the hand of the foreign partner. So unless under an agreement, foreign partner allows the local partner to run the business unilaterally, taking all the decisions, etc., it will not work. If they only allow the local partner to keep some of the directors to meet the minimum number of directors requirements, and they keep only maybe 1 or 2 directors coming from abroad and all other directors being locally available for convenience, for meetings, for routine day-to-day affairs, it does not mean that having majority in the board of directors give the local partner the control over the enterprise. It is quite possible that is still the foreign partner owning 70% of the business is still controls it. So for me, because board of director members are running the things in agency capacity, they can be replaced by the respective shareholders. So only having board of directors might not be the condition. But if the board of directors is kept under an agreement that 70% owner is allowing the 30% owner that I give you the right of managing and doing all these things and taking all the operational and financial decisions, and under this right, I give you right to have more directors, then this will count. So let me explain this agency concept now. An institution may manage an asset or a business for the benefit of stakeholders other than its equity holders through an agency, usually investment agency arrangement. Control does not include situations whereby this institution has the power over the business, usually through right to govern, but such power is exercisable in a fiduciary capacity and does not translate into variable returns for institution itself. In such cases, the control with regard to such business does not rest with the institution. Just giving an example, AAOIFI Board of Trustees has appointed Umar Mustafa Ansari to run day-to-day affairs of AAOIFI. In the agency capacity, I have like right to make payments and so many rights I have. I'm controlling the organization, but do you think that I should put a whole of AAOIFI on my own balance sheet? Technically, I'm doing it in fiduciary capacity. So any agreement that gives you power to govern, but under a fiduciary capacity only for the benefit and variable returns of the investors, then actually it is not it's not a control for me. So this applies to situations like al-wakala bil istismar and most types of restricted investment accounts where we believe that the control does not establish. Though further details are available in our other standards in the framework and in the standard on exposure drafts we have recently issued on off-balance sheet assets under management and the quasi-equity. So further details are available. It's actually part of a more comprehensive project. So there are 4 standards right now on which we are holding public hearings: control of assets and businesses, and quasi-equity standard, and financial accounting standard on off-balance sheet assets under management and transfer of assets. All these standards are linked together to each other and are related to the issues of investment accounts, wakala-based investment accounts, restricted investment accounts. All these things are covered in these, and the internal transfer between investment account related pools, etc. So we are trying to do all these things together. All of these further details are not contained in this standard. Rather, we need to refer to the standard number FAS 31 on wakala bil istismar, as well as the upcoming exposure draft on off-balance sheet assets under management. An institution may manage assets, liabilities, income, and expenses, including gains and losses related to participatory stakeholders on the basis of an unrestricted mudarba or musharaka. In most circumstances, the institution commingles and has an ongoing right to commingle these funds with its own funds and other funds under its disposal. These funds are in the nature of quasi-equity these funds are in the nature of quasi-equity where the institution retains the risk in relation to the invested fund. The institution acting as mudarib or working partner has the ability to exercise power to make decisions in relation to the use of and deployment of such funds. The institution in respect of these funds is directly exposed to and has rights to variable returns, negative and positive respectively, from its involvement with such business, along with having the ability to affect those returns through its power over the business or its underlying assets. In such case, the institution controls such business or its underlying assets. So what we are saying for quasi-equity, where you have variable returns, you mix your own, commingle your own funds, or has the right to commingle your own funds, and you have the all the power to exercise on the decisions related to deployments of such funds. And you have variable returns on both ends, positive and negative also, because of your involvement in your own commingling. You have the risk of losses also, as well as you have the power. So most of the conditions that we are talking about are met. So unrestricted investment accounts or other forms of quasi-equity, including some sort of sukuk, etc., they are going to be on balance sheet, while wakala bil istismar and others are going to be off balance sheet. Now, this is the crux of the standard, I would say. This chart, small chart. What we are saying that there are different type of structures which may have different characteristics. So, for example, you need to apply these principles to determine whether this thing is controlled by you or not, and this is kept on balance sheet or not. So, first is if you have unrestricted investment accounts without the right of having commingled funds. Decision-making powers are absolute. Benefit of decision, that is variable returns, partially benefit of decision you can take. Variable returns, you have only profit, you have loss in case of negligence only. Variable returns for own benefits, no. It can be based on judgment. Similarly, control, our answer is no, but based on judgment, it can change. But a urea without the right of having commingled funds would be off balance sheet. Not all urea will always be on balance sheet. Urea with right and responsibility of commingled funds. Decision-making power is absolute. With benefit of decision is yes. Variable returns are profits. Profits from all part, but losses related to your commingled part. Variable returns for own benefits, yes. Control, yes. We believe that the control exists as yes. I can give you an example from IFRS also, that from IFRS perspective, if you are having a mutual fund in which you have an investment of yourself as well, means that you have commingled yourself as well, your fund. So if you have not commingled any fund in a mutual fund that you are carrying, you will not be consolidating it. But if you have your own portion in that, so the condition for that is not 50%. IFRS is silent on that, but for that, there are different firms and different experts who have defined different percentages from 5% to 20%. But mostly, if you have 20% plus investment in that, they keep it as a condition. Here we are having the rights and responsibility of commingled funds, so we are keeping it as yes, and we are not putting that condition of 5 or 25%. Rather, we are talking more about principle-based rights and responsibility of commingled funds. So we are talking about that in this situation, it becomes you have the power and you have the variable return, so you control it, it becomes on balance sheet. Urea with commingled funds and musharka, always absolute. You have the decision-making powers are absolute. Benefit of decision is yes. Profits and losses are there. Variable returns for own benefits is yes. So you have the control. Urea with right and responsibility of commingled funds, including commingling of accrued profits. The question is decision-making powers, yes. Benefit of decisions, yes. Yes, you have profits and losses both. Variable returns are there and control is there. So we are talking about different situations with urea, and except for urea where you do not have the right to commingle funds, all other urea, we believe you control and you have the right to control, because you replace the assets and you need to, at time you increase your amount of equity, at time you reduce the amount of equity. So all these elements are existing there. Only in a urea pool where you do not have the right of having commingled funds. In that situation, it will be like, a judgment call whether it is on balance sheet or off balance sheet. But other types of urea, they are always on balance sheet. But in this one, in the first case, where there are no commingled funds and there is no right of having commingled funds, because in the column 2, you have the right of having commingled funds. So if you don't have that right of having commingled funds, in that situation, you will conclude like, no right, you conclude that it's not in control, but based on judgment, because other factors are also being considered. So you may apply a different judgment. Now coming to restricted investment accounts. Decision-making powers, you have the decision-making powers, but those are limited according to specific guidance. Benefit of decision, yes, you have. Variable returns, you have only profits, you don't have loss. You have loss in case of negligence, but you don't have loss actually shared from the transaction itself. So you don't have variable returns, and hence these are not controlled. So most of the RIA restricted investment account will go off balance sheet unless they meet the characteristics of URIA that we have provided in the earlier columns. Al-Wakala bil-Istismar, you have the decision-making powers only in the fiduciary capacity. You don't have them in your own capacity. Benefit of decisions is yes. Variable returns, you have only fixed fee plus incentive profit. So loss in case of negligence only. So you don't have the loss element. So the loss element is not there. So it means variable returns are not there and you don't have the control. So what is on balance sheet? Most of the URIA where you have the right and responsibility of commingled funds. Even if you don't commingle, but you have the right and responsibility of, when we say responsibility of commingled fund, mean that if there are some withdrawals, etc., then you need to pay back those withdrawals. So in that situation, your equity will kick in into that investment pool. So that is also a part of responsibility. So if you have it, they are all in control and having on balance sheet, while restricted investment accounts, unless they reach the criteria, meet the criteria of URIA, they are off balance sheet, and Al-Wakala bil-Istismar is off balance sheet. There is one condition under FAS 31 where Al-Wakala bil-Istismar becomes on balance sheet, where when Al-Wakala bil-Istismar funds are commingled with the URIA funds. That is additional specific condition, not a general condition for control. That is covered in our Financial Accounting Standard 31 already. I think we are running short of time, so I'll try to conclude now. Actually, we started a bit late, so let me try to conclude quickly. We don't have so many questions, so it means I'm too good in explaining, or the standard is too easy to understand, although it has so many complexities. So we will be welcoming any questions or comments even through email, and there will be one more public hearing on that. So let me try to conclude in next 2 to 3 minutes because time is almost over. Agency concept. Continuing, a partnership with the Musharaka Mudabba generally creates a joint control, whereas a principal-agent relationship, Wakala, Al-Wakala bil-Istismar or service ijara does not generally create a joint control unless other evidence of control is available from a different perspective, as I referred to about this thing. Variable returns for the purpose of this standard control does not include situations whereby the institution has the power, but such power is exercisable in a fiduciary capacity and not for the variable returns to the institution itself. It is clarified that performance incentives receivable by an agent are in a fiduciary capacity and hence not considered to be variable returns. The contractual or constructive right to variable returns does not effectively result in the control by the agent, as the return is not completely variable. It does not turn out into a loss into the agent, and the power is exercised on behalf of the principal. Additional considerations: the transfer of control of an asset for investment agency transaction or other certain structures like restricted mudarba has certain complexities in contemporary transactions prevalent in Islamic finance and banking. These structures may include a purchase undertaking to buy back the asset or guarantee in the capacity of a third party, as well as managerial or agency-based involvement in the maintenance, operation, or recovery of the asset. These are actually additional considerations on which we might have a slight difference from IFRS. These are the interpretation of the things applied. The main crux of these issues is Sharia does not allow you to combine two contracts into one contract. So the capacity remains separate. The underlying assets should generally be derecognized by the agent when sold to the principal if these were earlier owned by the agent as an independent seller. In addition, at times at inception or during the continuity of the contract, the agent procures additional assets or replaces assets for and on behalf of the principal. Such assets are also not recognized by the agent, even if similar anomalies exist with regard to the control of such assets. Following arrangements may lead to anomalies with regard to the transfer of control in an investment agency. Purchase undertakings are not contracts, but rather, Sister Farida, Brother Majd, I think purchase undertaking issue is not only for investment agency, but also for other options also. So I think we need to clarify that part. Purchase undertakings are not contracts, but rather future commitments are considered to be independent of the base contract. If these become a part and condition of the base contract, this is tantamount to Sharia non-compliance. Accordingly, purchase undertaking is not a contract and hence be considered as a commitment only and disclosed accordingly. However, if it is expected that a purchase undertaking needs to be executed in a manner that may result in form of a loss, to the institution, in such situation, a provision against such expected loss shall be created in line with this standard and our FAS 30. A guarantee permissible by Sharia perspective is provided in the capacity of a third party or by a third party independent of the contract of sale or transfer of asset, duly executed after consummation of the sale and cannot be made a condition thereto. So in a nutshell, a purchase undertaking or a guarantee in Islamic finance contracts will not be combined together with the base contract and will be considered separately. When these are considered separately means that they will not be considered for the purpose of determination of control. This is the difference between AAOIFI and IFRS. AAOIFI FAS believes that when we do separate contracts or separate promises, those are for the purpose of Sharia compliance. You can't combine together. So if they cannot be combined together for transaction purposes, they cannot be combined together for accounting purposes. This is like something that we have a clear view. So from that perspective, I would like to submit that these are the things where you need to keep in mind that here the interpretation of control from AAOIFI perspective is different. Same applies to the management and agency arrangements, because under IFRS, if you have continuing involvement through management or agency arrangements, it is considered that you you have not passed on the control and you continue recognizing the asset and you don't de-recognize the asset. We have clarified again that these are done in different capacities, and from Sharia perspective, you cannot combine the two capacities. So even from accounting perspective, these will not be considered as part of control. There are some specific considerations for sukuk. We have exposure draft of FAS 29 already in market. It was there. Then we issued a revised exposure draft again after a review by the Sharia committee. Most of the elements that we are discussing about are there. When the institution has made an assessment to consider a sukuk to be off balance sheet due to lack of control of the institution over the sukuk shall continue to be considered as off balance sheet for the consolidation purpose. That is an additional clarification. Effective date, this standard does not have an effective date because this is conceptual standard. The conceptual standards are not to be applied from a future date, but rather they are considered to be applied even from the history. It is just a clarification of what the framework wants. So from that perspective, this standard, as soon as we finalize this standard, it will become effective immediately. With that, I know that I have taken maybe a few minutes above. No, it's exactly the same time, but I have two questions here. I would like to take the comments. Now, this is good. Thank you very much for the poll. Poll says 85% of the members of the participants want the respective standards to retain the remaining related requirements because it might be helpful for understanding those standards. Thank you very much. It's a good sort of comment. Sister Farida, Brother Maj, please make a note of it. Thank you very much again. Now, let me take you to the questions that are there before we conclude. We have comment from Amanda Matikazala. Thank you for giving me opportunity to read through the exposure draft. Please note my suggestion below. Unfortunately, I can't see your comment here. So if you can send it, and then at a later stage, if you can send it. Brother Mufti Khwaja Nurul Hassan, Assalamu alaikum and welcome, brother. Any comment on Ijarat al-Musha in lieu of Pakistan's IFAS Ijara standard? Brother Khwaja Nurul Hassan, sir, in Pakistan, actually, on diminishing musharaka, there is a separate standard, but that was never applied. Actually, it was issued as exposure draft, but that was never applied in the market. So I think that standard also keep things on balance sheet. But from our perspective, the explanation is quite available in quite detail in form of this FAS 32. I think FAS 32 actually addresses your issue also. We can discuss it offline separately because right now the time is over and this is not directly related to this subject. FAS 32 covers these conditions. I can see Sister Amal Al-Masri has raised her hand. She is heading our relevant working groups on some of these projects. So please, Sister Amal, please go ahead.
Yes. Finally, in additional to what Brother Omar said about the importance of this standard, I would to add this standard removes the confusion occurs when classifying some assets on balance sheet or off balance sheet. So this standard integrates with another standards, in particular off balance sheet. It is still exposure draft. Thank you for all comments and for all attendance. Wassalamu alaikum wa rahmatullah.
Thank you very much, sister, for like all the hard work that you and the working groups are doing on these areas, and thanks for attending and being available here. With that, I can't see any other Q&A, so I would like to thank you all, and Brother Much, I think we can conclude now.
Sure. Thank you, Brother Omar, Mr. Omar Mustafa Ansari, AAOIFI's Secretary General, for the insightful and comprehensive presentation of the exposure draft and the answers provided to participants' questions and comments in today's public hearing session. And we hope that it served the purpose of spreading and enhancing awareness of the public and the industry of AAOIFI's newly issued draft standards. In conclusion, we would like to thank all our valued participants from across the industry and beyond for having taken part in today's public hearing on the exposure draft of control of assets and business. Your comments and suggestions are essential for AAOIFI in improving and fine-tuning the exposure draft for finalization of the standard by AAOIFI Accounting Board for issuance. As I mentioned at the start of the session, all relevant comments and suggestions will be compiled and presented to the respective working group to consider and make the changes it deems appropriate to the exposure draft. A public hearing in Arabic for the same exposure draft is set to be held at the end of May 2023, inshallah. We also have on our calendar more of such events in English, inshallah, in the near future. A word of appreciation also goes to all accounting board and other board members who have joined us today, and also to AAOIFI staff who helped make this event a success. Thank you all, and see you, inshallah, next time around in the future public hearings on AAOIFI financial accounting standards. Allah bless you all. Fi amanillah. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much. I think Sister Amanda has now sent her comments, seem to be good comments. I just request Sister Farida to take note of it because the time is over, the event is officially over. So, but if you can just take a record of this comment and we'll discuss it in the working group, inshallah. Thank you very much for valuable comments, and apologies for, because we received it after officially closing the session. So inshallah, we'll address it. Thank you very much again. Thank you, everybody. Assalamu alaikum wa rahmatullahi wa barakatuh.